All right, we're live. We're back in the air. Hey, I'm Mitch Goldberg, wealth management firm here, Client First Strategy. And I thank you for joining me. While you're watching this, give it a thumbs up, share it, with your friends. Just by giving it a like, your friends will see it. If you're following us on YouTube, please consider subscribing. We post a lot of content. We're available to speak with you, so we're very accessible. Markets hit a new all-time high in a really powerful rally. Why? Because the Fed cut rates? Not just because of that. The market has rallied already on anticipation, or in part on anticipation of lower rates. But what's come into vogue is that historically, when the Fed gets into a rate cutting cycle and the US economy does not fall into recession, the stock market typically has gone up every time, actually, and a lot. And that's what we have. We have the belief in that now that we are having a soft landing, meaning the economy slows down enough for inflation to come down to a more acceptable rate that's considered acceptable by both the Federal Reserve, businesses, and consumers, which is roughly around 2%. But the economy doesn't weaken enough to cause a recession. And when you have that kind of environment, Goldilocks, as it's called, that's really what it is called. You have expanding or rising PE ratios. You have investors who are willing to pay more for stocks. So if a stock has a high valuation, all of a sudden that valuation isn't considered so high and the stock can go higher. And it draws in money into the market and stocks go up. We're going to talk about this. So we're going to talk about what's not going up, because you should take a look at that also. All right. So this is going to be a quick show, educational. Don't mind me. I'm a little punchy. I'm a little tired. I was here till 9:30 last night. Hey, if you're watching this in the replay, I'd like to thank you for joining me as well. And you'll get a lot out of this. Here we go. All right, here we are. Sometimes the intro could get stuck. That hasn't happened for a long time. But the Fed has decided to pivot. And that means we haven't had an interest rate cut by the Federal Reserve in 4 years. So we had an interest rate hiking cycle because inflation went up. Let's just talk about that for a moment, inflation. Now, when you see the rate of inflation coming down, that does not mean that prices are going down. It just means that prices for things, goods and services that are commonly used by the public, they're just not going up in price as much as they were. So this is why when you say to people, regular, everyday, average people, inflation's coming down, inflation's low. And they say, are you effing nuts? You see the prices for everything? That's because prices didn't go down, it's just that the rate of increase slowed down. So it depends, if you're an economist, yeah, inflation's come down a lot. If you're a business or a consumer or anyone with a pulse, uh, prices are up. And, prices are up a lot higher than they were in 2019, 2020. There are reasons for that. Now, someone's going to get all political on my, on my butt. Okay. Inflation comes and goes. The United States spent trillions of dollars, about $8 trillion during the pandemic to keep everybody in good shape, keep everybody home, and prevent the whole entire economy and every business from disappearing when we got out of the pandemic, which we didn't really know for sure when we would. it was an open question as to how long we'd be in the pandemic and how long the shutdowns would last and how long we'd have to keep printing money. But the economy reopened while all this money was still being spent, provided to consumers and businesses. The Federal Reserve kept doing what's called quantitative easing by buying treasury securities and mortgage securities. And it created, everything combined, plus supply chain disruptions, created inflation. We already had a little bit of inflation, but it created a lot more inflation. How about that? So there are a lot of circumstances going on here, and to blame one person is ridiculous. To say, well, Trump spent $8 trillion when he was president and increased the debt. It's true, but he didn't do it by himself. He did it with Congress. Biden didn't do it because he still caught the tail end of all that money printing, and the money printing was still going on when he was president. The Fed was still doing quantitative easing when he became president. And it wasn't until inflation started to get out of hand that we realized we went from the big problem of deflation and an economy that ground to a halt. We went to inflation and an economy that was heating up too much. Based on everything I just said and that I've looked at, I'm surprised inflation didn't go higher. It got up to about 10%. And I know people are going to say, we had 10% inflation. We had 10% inflation for about a hot minute. And then went down pretty quickly. And the Fed got aggressive. They raised rates, and then they raised rates 4 times in a row by 3/4 of a point. The Fed typically raises and lowers interest rates by a quarter point. So when you see the Fed make a move of a half a point, a 0.5% to 0.75%, it's a big deal. But now it looks like the economy is slowing down enough to bring inflation down. Now, some will say we're already in a recession. Some will say we're heading into a recession. I think politically, you're going to say, if you're on the right, we're heading into a recession. We're in a recession. If you're on the left, you're going to say we're avoiding a recession. We're just slowing down enough to bring inflation down. I don't like these calls I'm hearing all the time based on someone's politics. It's just follow the data. And the fact is, we don't know how the data is going to go because we're not wizards. We don't have a crystal ball. Maybe we do go into recession. Maybe we don't. But whatever becomes the prevalent belief by investors, hard landing / recession, markets going down even with interest rate cuts. Soft landing, slowing down without causing a recession, bringing inflation down with interest rate cuts, the stock market's going up. And whichever one of those is more prevalent with investors' beliefs is the one that's going to guide the market. So this is just a massive tennis match between two different gigantic psychologies. And that's really what it is. And I'm telling you, it is as simple as that. Now, would I change anything about my investments? You know what? Like 3-4 weeks ago, the Dow was down 1,000 points in a day. We had the carry trade with the yen falling apart. People are swearing up and down that we haven't seen the last of that. It's going to continue to get worse. There's going to be a lot of aftershocks. It's just getting started. Well, nothing's happened since then with that. And this is what happens when you start to go into recession. And people got very scared and the market went down for a couple of weeks. And then, and what happened is the recession psychology took over, the prevalence of that. And now we're flipping it back to no recession. The Fed cut rates 0.5%, which is outside of the norm. Usually it's a quarter point. I myself thought they would just go a quarter point, 0.25%. And because I said, they could always do 0.5 point later if the data dictates that. But the Fed could go very gradually because it's a very gradualistic, glacier-like moving institution, but they did the half a point, and it's juicing. It's juicing the stock market. It's going to take a little while for this rate cut uh, to work its way into the economy. I don't think rate cuts take as long, or rate increases to take as long to work themselves into through the economy as they used to, because we have a much faster economy, much quicker velocity of money, news flow, trading. Everything is happening faster. Velocity of money is an economic term that means how quickly money could change hands. And with apps and online banking and all that, it's just money moves incredibly fast. And once money starts moving incredibly fast, it's hard to slow it down. All right. So, what do you do about all this? Do you make changes based on the prevailing uh, concern or not concern of a recession or not a recession going back and forth? No. I'm telling you that one of the cornerstones of investing and planning, and they all and insurance, they all go hand in hand. It's all like the big thing is you are controlling what you could control and dropping the things you can't control. We can't control if inflation rears its ugly head. We can't control the politics. We can't control what the Federal Reserve does. We could control what we do. So, if you're investing in your 401k plan, keep doing it. If you have an asset allocation model that's working for you for your investments, and it's working for you if it was based on your time horizon, your risk tolerance, and you help decide what it is with your financial advisor, you're good. You don't have to do anything because the market cycles, the interest rate cycles, these are factored into it. These are all just part of the long-term trends. We've always had cycles, and this is not going to be the last one. And I think the people who change everything based on the changing on the wind changing are always setting themselves back and never catching up. And I know this from personal experience because I've seen people do it before, and I'm here to stop them. As a financial advisor, once I get a client's account all set up, I get the investments all set up, beneficiaries all set up, trust accounts, titles, insurance, all of these things. I get them all set up for the client. I go into a different mode. I spend more time advising clients on what not to do than what to do. Only in the beginning is it really, advising the clients to do this, to do that. But once you're past that, which goes by pretty quick, you get into a new mode and you're saying what you shouldn't do. And it's almost like, not almost, I'm basically protecting clients from their worst impulses. So I wouldn't change a thing with investments based on changes to Fed policy. Now, I know a lot of people are going to say, well, but now interest rates are going to go lower and I'm going to get less money in my savings account. If your whole investing strategy was based on what you get in a savings account, you're not really investing anyway. Because the money that you have in your savings account is maybe you have your emergency fund in a savings account, you have known expenses coming up in a savings account. The rest of it is invested, right? The rest of it is invested. And when it comes to investing, you probably have been advised to don't keep buying 6-month T-bills over and over and over. Buy some 2-year, 3-year, 5-year, and 10-year bonds, Treasury bonds, for example, because when short-term rates do go down, you won't have to take all of that reinvestment risk. So that if interest rates go lower, you won't have to keep reinvesting with a lower interest rate and get less income from your passive investments. So the days of that 5% high yield savings account, they're over. That's it. But maybe you could get 4.5%. It's still not too late to diversify your bonds in terms of maturity and your CDs and things like that. Diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. You've heard me say that many times, right? So I'm not making big changes to a portfolio. I'll tell you what I would make changes based on. I would make changes based on life cycles. You get married, you have a child, death in the family, divorce, retirement. As you age, you make changes, okay? Because you're going from more growth oriented to more stable and income oriented investing as you get older. Those are reasons to make changes. Not to say that we should sell our tech stocks and put all the money into utilities and preferred stocks, and then we should sell all those because they went up too much, and then maybe put all our money into preferred stocks and consumer staple stocks and stocks that just pay high dividend yields. And then we should move our money back in here. I mean, this stuff sounds good when people on TV say it. I don't even know if they're doing that with their entire portfolio or a part of their portfolio. But this has nothing to do with you. But you have a tendency to take what you hear in the news on TV and take that as gospel and think, I should be doing that. And no, you shouldn't be doing that. You should take the time to see if you should be doing that. But don't be impulsive and say, oh, I'll do that. I need to do that. No, don't do that. Let's take a quick look at how the markets did today. Dow, new record over 42,000, up 522 points. NASDAQ up 440 points, up 2.5%. That is a huge day for the NASDAQ, up 2.5%. S&P all-time high, first time ever, closing above 5,700, up 95 points, up 1.7%. Gold up a little, oil. Well, listen, oil is up. But what did you expect? If interest rates go down and we're not going into recession, then now it's expected that oil demand is not going to collapse. Therefore, traders bid oil futures higher, and you see the spot price go up, which is what you're looking at, the spot price of West Texas Intermediate crude right here at 72. Okay. 10-year yield went up a little bit, 3.71%. Why? Because if we're not going into a deep recession, maybe the yield has gone down too much, and the VIX is down. That's expected. Utilities were off. Okay, why would utility stocks be down? Well, they've been up a lot lately, so buying them or selling the news. A big day for the Russell 2000 small cap stocks, up over 2%. Commodities, copper at a multi-year high. I think that might be an all-time high. But, you know, maybe cutting rates will spark more inflation. The Fed will say, shoot, we cut too soon. We don't know yet, and I'm not waiting to invest to find out. All right? But this is what's the most interesting thing. The 2-year at 3.58 and the 10-year at 3.79. Definitely a normalized yield curve. We no longer have an inverted yield curve. Definitely a normalized yield curve. And I want to show you a couple of stocks here. I'm going to do my best to plop this in front of you with a rather large screen I'm looking at. All right. But I want to show you something. And then we're going to go. I'm going to let you guys go. But these are the magnificent 7 stocks, the big ones, right? Tesla, NVIDIA, Meta, Apple, Netflix, Amazon, Google. We talk about these stocks all the time. But you notice, even though we're at record highs, Google is, see that red? That's how far it's off its high. Microsoft off its high. Amazon off its high. Apple off its high. NVIDIA off its high. Tesla off its high. Most of these stocks are not trading at highs. And what this means is other stocks are doing the work. There's more pull from other stocks. And that tells me, one data point at least, that this rally is actually a pretty healthy rally. And it could be trusted, it could be respected. And that it's not just the super mega large cap stocks going up. It's starting to broaden out. And the lowering of rates and the belief that we're avoiding a recession is really adding a lot of fuel to the fire. Have a great day, everybody. I'll speak to you tomorrow. I'll be back Monday. All right. Unless something crazy happens tomorrow. I usually don't do the show on Fridays. Unless something, again, crazy happens. And in this day and age, you never know. But hopefully, we won't have to do this tomorrow. All right. Have a great day. Thanks so much for watching.